Hi, this is Ola Ibiwoye of Commercial Property Club. Once again, we are diving deep into commercial property analysis. Today's topic will be vacancy and credit laws. What is vacancy and credit laws? Vacancy and credit laws is the potential income that is lost due to spaces in an income producing property that lies unoccupied or due to non-payment of rents by tenants. Now, considering the gross scheduled income, that is the property's total potential income, less of vacancy and credit loss will always give you the gross operating income, which is your GOI acronym, which is the revenue you will collect in total with your property. In some circles of industry, this term sometimes is referred to as vacancy and credit allowance, and this reflects future losses that may occur due to turnover and rent delinquency in an income producing property. Some real life factors that may contribute to this situation in an income producing property may be sometimes due to difficult economic times for renters. Sometimes it might be due to supplies of that kind of property which may outwit the demand from renters. And that may affect rent rates, which renters can take advantages of by moving to a less rent space. How to calculate vacancy and credit laws? This would normally be given as an estimate as a percentage of the gross scheduled income. Let's say this ratio goes like this. Vacancy and credit loss equals gross scheduled income multiplied by the percentage vacancy and credit loss. And that's an estimate actually. Let's say, for example, an apartment of 100 units is 100% occupied with a gross scheduled income of $600,000. And you factor in a rent increase of 5% the next fiscal year, and also consider a 2% vacancy credit loss. Now, to determine is to anticipate the loss first by calculating the gross scheduled income. If you are expecting a 5% more in lease that year, take the current year's amount and multiply it by 1.05, which is a multiple of the current by 1 plus 6% more. So your next year's gross scheduled income will be equals to 600,000 multiplied by 1.5, and that will give you $630,000. Then calculating the vacancy and credit loss will be a percentage of this income, which is vacancy and credit loss equals $630,000 multiplied by 0.2, which is equals to $12,600. That would be your vacancy and credit loss amount if you were to forecast for that 100% unit apartment. Now, in conclusion, it must be said that every income producing property would experience vacancy and credit loss at some point in time. It's just only a matter of time. But as investors, a critical look into the vacancy and the credit loss situation of an income producing property that is being considered for purchase is key. The extent and the real situation of the loss must be determined to see if it's a value add situation once the property is purchased. And that puts you at an advantage. However, your lenders will always require you to estimate a situation of vacancy and credit loss in future income statement projections of the property irrespective. This is another wonderful indication of value when it comes to commercial property analysis. My name is Ola Ibiwoye of Commercial Property Club. Thank you for joining me for this particular topic.